You wanted to invest in the Nifty 50 index fund. When you searched, you likely came across two options: Nifty 50 index fund, which is market weighted, and Nifty 50 equal weighted index fund. If you don't know under what conditions you should invest in either of them, then this video is just for you. Stick around as we break everything down with data to answer all the doubts you will have regarding the returns of these funds, how they behave in different market conditions, risk or volatility, and is this a good choice for you? We analyze 7 years of NAV data of ICICI Nifty 50 Index Fund and DSP Nifty 50 Equal Weighted Index Fund for answering these questions. Let's get into the video by quickly recapping what does equal weighted and market weighted mean. Index means a basket of stocks which are grouped together. So Nifty 50 is India's top 50 stocks listed in the National Stock Exchange. Now, the market weighted index is one in which constituents are added to the index based on their market capitalization. Market capitalization is nothing but market value of the company, which is equal to number of publicly traded shares into price of the share. Equal weighted index is one in which constituents are added in near equal proportions to the index. So in Nifty 50, almost each stock will be 2% of the index. This ensures that each stock drives the index in equal proportion. Look at the constituents of the market weighted index. You can see 38% of the index is driven by financial services, 11% by IT sector, and so on. Now look at the constituents of equal weighted index. See, the financial services is 24.93% versus a 38% earlier. Similarly, auto components is 11.9% versus 7.04% earlier. Take a pause, look at the constituents and appreciate the differences and see how an equal weighted index is actually quite nicely distributed. Top 3 holding sectors contributed 56% in market weighted index versus 46% in equal weighted index. Now, you should also have a look at the top 5 holdings of equal and market weighted index. Pause the video, have a look at the difference. Now, let us look at how the funds behaved in the last 7 years from 2018. The large cap growth trend in 2018 resulted in the market weighted index absolutely doing better than the equal weight index. Essentially, market weighted index follows the momentum style, if you understand it. The more the stock grows, the more the weightage that stock or that particular sector will have on the index. Price has a direct correlation with the weightage in the index. Look at how equal weighted fund is performing in the bear market. Specifically, look at March 2020, the COVID fall, and November 2024. Both the times, equal weighted crashed significantly more than the market weighted. So we can see again that equal weighted caught up with market weighted during the mid cap small cap rally of 2023-24. Now that you understand the trend, let us look at the returns in a bit more detail. The 7-year CAGR or annualized returns of both the funds were the same. Nifty 50 market weighted was 13.79% versus 13.74% for equal weighted. Hardly any difference if you do a one-time investment in each of these funds. But I generally also like to compare the returns from a SIP perspective. Some wonderful insights popped up for a 10K SIP for 7 years. Prepare to be shocked, folks. As expected, market weighted fund returned highest on the first day of the month, and the portfolio value was 14.87 lakhs. Equal weighted fund, meanwhile, returned highest on the 22nd day of the month, and the portfolio value during the same period was 16.51 lakhs. Do you remember which day of the month the mid-cap funds generated the highest returns for SIP? You saw in this video, it was on the 22nd day of the month. So essentially, folks, equal weighted portfolios show patterns of a mid-cap fund with higher volatility, as you can see here. But why did SIP and equal weight return more than the market weighted? One, equal weight index is almost like a contra investing strategy. Investing even in stocks which are not doing well right now in equal proportion. Two, Compounding effects, since you invested in poorly performing stocks, collecting more at cheaper prices, and when they start doing well, you have enough investments in them to make a significant impact to the returns. 3. Equal weighted stocks seem to be performing better when the mid and small caps are doing well. Looking at the riskiness of the funds, we can clearly see equal weighted funds are more volatile than the market weighted funds. What should you do? For a one-time bulk investment, market weighted is definitely better for you. Lower risk, same returns. If you are a risk-averse investor, equal weighted is not for you. This is going to test your patience, and if you stop the sip in the middle, then you're better off going with a market weighted fund. If you're a patient investor who is ready to wait through cycles of bad performance for good returns, then equal weighted could work for you. Equal weighted behaves like a mid cap fund and will have periods of low growth where you should not be stopping your investment. SIP on the 22nd day of the month returned the most for equal weighted funds. We should learn from past behavior but be mindful of changes which might happen. Let me know in the comments what you think.